Class, this video is about the balance sheet. We will focus on the parts of the balance sheet or the problems on the balance sheet that were probably not covered in your earlier accounting classes and discuss what those items might be and how we need to handle them. First of all, review that typically a balance sheet, classified balance sheet, is divided into current assets and long-term assets. And you'll see here that here at Procter & Gamble, we have the current assets listed first. Now, U.S. GAAP does not specify that current assets have to be listed first. It's kind of tradition that we list our assets from most liquid to least liquid, but that is not codified in the rules. But what is required is that you differentiate between current and long-term somehow. So in this case, Procter & Gamble has put a total of current assets, and then all the others are long-term. So a couple of items that we want to talk about that may be new on here. First of all, under current assets, there is current assets held for sale. Now, when a company sells a piece of its business that is significant enough to change their strategy, then it is referred to as discontinued operations. And when that happens, the assets that are to be sold are split out from the rest of the assets. So here we have a situation where Procter & Gamble decided in 2016 they were going to sell part of their business in 2017. It fit the criteria under U.S. GAAP to be a discontinued operations. Therefore, on the year-end balance sheet for 2016, all the assets that are going to go away with the sale of the business segment are listed but separated. So instead of being in with materials and inventory and other assets, it is all of them are on one line item, and we refer to them as held for sale. They are current because they're going to be sold in the next 12 months, so they certainly are not long-term assets. So those need to be separated out when you have a discontinued operation. So when you see that current asset held for sale or something similar, that means that there was a discontinued operation. And the reason why is then you can compare 2016 without these ones that are going away with 2017 where they have gone away. Now, a couple of other items. Remember, notice property, plant, equipment is listed as net. That's after accumulated depreciation. Most companies list only the net on the balance sheet. They do not show accumulated depreciation except in the footnotes. Same thing with their their intangible assets. Now, going down the balance sheet a little further, we look at a couple of other items. First of all, we have the same classification. We are required to differentiate between current liabilities and long-term liabilities based on the due date. And that is whether it's due in 1 year or past 1 year. So current liabilities, all 30 billion of them are due within the next 12 months from this balance sheet date, which in this case happens to be June 30th, 2017. So for the next 12 months after June 30th, this is what is due, $30 billion. Now a little bit about this debt due within 1 year. Sometimes you'll see it called current portion. That's the part of long-term debt that is due in the next 12 months. So if you think about your car loan or student loans, there's a total amount that is due over the next, say, 5 years. That would not be a current liability, but the part of that that's going to be paid in the next 12 months is a current liability. The remaining 4 years is long-term debt in this case, or a non-current liability. So things that are paid off so much every year or every month, whichever, need to be split between a current liability and a long-term liability. So when we see that debt due within 1 year, as of 2017 or June 30th, 2017, Procter & Gamble is going to have to come up with $13.5 billion to pay that off. And we're very concerned on the balance sheet with the ratio current assets divided by current liabilities, because the banks pay attention to that because it tells us our ability to meet our obligations. So the current ratio is, as you've reviewed before, current assets divided by current liabilities. And that's why it's important that we differentiate what is current and what is long-term so that we can calculate that ratio. Now, a little bit about debt due within 1 year. Often a company will borrow money for a short period of time with the intention of refinancing that for a longer period of time. So if you have amounts that are due within 1 year that you have the intent to refinance for a long period of time, you can move them from current liabilities to long-term liabilities. Now, it's not just willy-nilly, oh, I think we'll do that. No, we have to have an agreement in place at the balance sheet date. So for Procter & Gamble to do that, they would have to have an agreement in place by June 30th, 2017 with a bank that the bank has agreed to in writing that says that they will refinance the debt. Even if it hasn't actually been refinanced by the balance sheet date, the agreement has to be in place. And those agreements almost always come with conditions, meaning there has to be a certain amount of assets or a certain current ratio or debt ratio. The company must be in compliance with all those agreements. If that's the case, you can move it from current liabilities, where it should be current debt due within 1 year, down to long-term debt. And that would improve your current ratio, which is why we have criteria for doing that. So we don't want companies to improve that just because they want to. Now, going down a little further in the liability and equity section, just a quick review of the equity section. You see that Procter & Gamble has preferred stock, then common stock, then additional paid-in capital, and then there's some other items that tend to be down here at the bottom. We want to make sure we pay attention to treasury stock. We're going to talk a good deal about that more in a later lesson. And accumulated other comprehensive income/loss is related back to our statement of comprehensive income, which we reviewed last week. Retained earnings is important. That's increased by net income and decreased by dividends. And so, like we talked about the statement of equity, the statement of changes in owner's equity would be a description of what changes between the beginning balance sheet and the ending balance sheet in the equity section. So you'll see, for instance, like common stock didn't change, and that's often the case. It doesn't change a lot. And so that column would be basically blank. It would not have any description of what changed. But any of these others would have transactions or descriptions of what changed. Now let's look down at this non-controlling interest. We talked about the non-controlling interest as it relates to the income statement because the company adds all the revenues, all the expenses from a subsidiary that they own more than 50% but less than 100%. They add all of the revenues and expenses on the income statement and then subtract out the part that belongs to the minority shareholders. Same thing here, except the balance sheet has all the assets and all the liabilities, and the difference in equity is right here at the end. This is the equity that represents the amount that those minority shareholders own. Minority in the subsidiary. So if they own 80%, they control 100% of the assets and liabilities. So all of those are added in here, but the equity part is separated out. The equity that represents the other 20% of that subsidiary is right here in non-controlling interest. It's usually a pretty small amount, but it should be the last item in your equity. That's how it's designated under US GAAP. So there's your balance sheet. The two ratios, again, current ratio we talked about, debt ratio, total liabilities divided by total assets, or sometimes it's measured by looking at just long-term debt divided by total assets. But that is the debt ratio, is also carefully watched to see if a company is getting too much debt or too much risk that comes along with that.